Good afternoon, judges. We are Team H, and we will be presenting Netflix and our buy recommendation. Our thesis is that Netflix is sustained for outperformance by leveraging its emerging market, its capital-light and efficient model, and by expanding its advertising tier.
So a little bit about Netflix and their core business model is that they're a subscription-based business model. They offer original content to over 325 million subscribers, and they have a significant international presence with 56% of their revenue coming from outside of the United States and Canada. They're also more interactive with their users through data-driven recommendations. A few of their largest and most notable competitors are Disney, Warner Brothers, Discovery, and Fox. And a few key metrics that you may want to know is that they have a market cap of $405 billion. They have a net income of last year of $11 billion and an EPS of $2.53 in 2025.
Now, jumping into our international catalyst, you can see that the return on invested capital for their international original content is 3.7 times greater than their US licensed content. And on the bottom left, you can see that the international view share versus their local view share is much greater, signaling Netflix's ability to generate and produce content from local to international. Additionally, we see Netflix's unique ability, unlike its competitors, to penetrate into emerging markets through various different strategies. And lastly, although the Asian and Pacific and Latin America only make up 24% of Netflix's current revenue, we see these two regions as being the key drivers for their international growth.
One way that Netflix has been drastically increasing their revenue is through ad tier expansion as well as price increases. Just last year, their ad revenue growth more than doubled at 2.5x, and Netflix is forecasting that, as you can see in the top right, to almost double again in 2026. In addition to that, for the revenue growth from 2025, 15 to 60% of that revenue growth was from ad tier expansion as well as price increases, and we only expect that number to continue to increase in future years. Also, going off of what Natalia was talking about with international markets and penetrating them, one of the ways that they do this is through lower price points. As you can see in the Asia Pacific as well as Latin American regions, their price points is around $7 to $8 average revenue per member, whereas in the United States it's over double that at $17.26.
Netflix operates as a pure play streaming platform. This means that they license IPs and finance production. Out of the top 50 shows, 33 were Netflix as of March 2026, showing that they're out-competing producers, pure producers. They also have a 25% return on invested capital, meaning that they are having a higher return while spending less if they have a median content spend.
Now, moving on to some of the risks that we see for Netflix, given its growing internationality and it operates within 45 different currencies, any major exchange to the currencies can have a 1% to 2% effect on their bottom line. Additionally, we see different maturities for their markets of the US and their international markets, where the US markets, they're looking to increase prices instead of finding new subscribers, where vice versa is true for international markets. And lastly, the structural consumption shift. Throughout Netflix's history, we've seen a change in preferences for media by different generations, and this continues to be true. Newer generations are going into streaming and user-generated content, and Netflix continues to adapt through this.
Moving on to our share price history, we hit significant bottoms in the middle of 2022. Netflix bounced off of those bottoms after announcing their ad-supported plan announcement and a crackdown on password sharing. That drove revenues and really high earnings per share for the next 2 years, up until the end of 2025, when Netflix announced its deal offering for Warner Brothers at about $85 billion. Markets reacted very poorly to that and went down about 40% from the share price at that announcement. About 3 weeks ago, Netflix rescinded that offer, and the share price is up about 30% from the price at which they rescinded. And so we see right now as being a really good time to get in at a discount on a very high growth company. Moving on to our valuation, you can see that we calculated a WACC of 7.62%, a terminal growth rate of 2.6%, and an EV over EBITDA exit multiple of 10.2 times. Our intrinsic share price calculated with the EV over EBITDA model was $125 per share, and our intrinsic price with the perpetuity model was $102 per share. Moving on to our free cash flow projections, we projected free cash flow of $37 billion in 2030, the main assumption of that model being Netflix hitting its goal of $30 billion in EBIT at that same year. We weighted our valuation at 70% for the EV over EBITDA model and 30% for the perpetuity growth model, which gave us a target price of $118 per share. And our earnings per share projections were at 18.15% CAGR for the next 5 years for EPS, which we see as conservative compared to the 25.44% CAGR we've seen for Netflix in the past 5 years. Moving on to our scenario analysis, our bear case assumptions gives us an 8.36% upside, our base case was a 16.6% upside, and our bull case was a 25.4% upside. The assumptions on those models were a revenue CAGR, a 5-year revenue CAGR between 12.5 and 15.5%, EBIT being between $28 billion and $32 billion by 2030, ad-supported revenue being between $5.5 and $9 billion by 2030, and a membership retention for our base and bull case projections maintaining with increased price hikes both in the US and internationally. And as for catalysts for short-term share price appreciation, we see certainty coming back from the Warner Brothers deal turnout, continued earnings per share beats, and continued ad-tier growth being the three biggest drivers for share price appreciation for the next few years. As for our valuation analysis, we can see that we're in the bottom third of our 52-week high-low, we're in the bottom quartile of our analyst price targets, and we're well below both our base and bull case projections, and so we see significant upside for Netflix in the next coming years.
Netflix outcompetes in ROE, ROA, and EBIT margin. Focusing on their EBIT margin, they have a 24% margin compared to the industry average of 14%. Their ability to generate cash flow and without being leveraged like their competitors shows great operational efficiency.
One final analysis that we conducted was a DCF Monte Carlo simulation. We ran 10,000 simulations using our base case DCF assumptions that resulted in similar upside metrics of around 19.8%, which would mean at a current price of $99, that'd be $118. 70% of the simulations said that Netflix was undervalued, and only less than 100 of the simulations said that Netflix was with a price under $100.
We recommend to buy Netflix at $98 per share with a target price of $118. Thank you guys.
So they raise prices and put ads every 10 minutes. What was your assumption for user churn? At some point, people will turn it off, won't they?
Yeah, absolutely. We don't see any decrease in membership retention for the increase in ad tiers just because they're significantly cheaper than their non-ad tiers. They've been increasing prices at about 30% since 2024 for their non-ad tiers and significantly less for their ad tiers. And so we think it's a lot more cost effective for the consumer, which is a big goal for the consumer. And so we don't see membership retention decreasing.
In fact, Netflix has one of the highest membership retention rates out of all the competitors at roughly 98%.
And in addition to that, they started testing ad tier only tiers in international markets, and it's been pretty sticky there so far.
Will you go to your financial analysis slide for a minute? Yeah, that one. So I'm looking at the bottom left, and it says region revenues. That's equity risk premium. Is that?
Yes, that was a part of our WACC calculation. That was a weighted equity risk premium.
Why is it different? Why is Latin America and Asia Pacific so much lower than the U.S.? I mean, why is it? I just don't understand the logic of different. The equity risk premium to me is for the entire company, not for geographical areas, because you're buying the equity of the entire company. So anyway, just discuss the logic of that.
Yeah, we looked at the equity risk premiums for Latin America, for example, which is significantly higher than that of the U.S., but we weighted the final ERP just at how much revenue we actually gained from Latin America. So we see it as affecting their total ERP significantly less than, for example, that of the U.S., because 56% of their revenue comes from the U.S. and Canada.
So you're saying that Latin America is a riskier region?
Yes.
And thus needs a higher return, but it's only 11% of the total.
Okay.
Yes.
Is that what you're assuming?
Yes.
And what was the logic behind going after Warner Brothers? It seemed to be totally against your thesis and their thesis.
Yeah, absolutely. Do a slide for that.
Well, the Warner Brothers acquisition was, in Netflix's own words, nice at the right price, but not must-have at any price, right? Warner Brothers is a very asset-heavy, very legacy IP company, right? It's almost like a cash cow, very low growth. So Netflix was going to pay $27.25 per share, which is about where the stock is right now. Paramount jumped in and bid $31 per share and took that from them because Netflix didn't want to overpay. But at the same time, Paramount had to take out about $53 billion worth of debt, which lowered their bonds to BB plus junk territory. And analysts expect them to take 4 to 7 years to even gain a positive ROI on that investment. So, Netflix never saw it as something they needed. I'm sure they were just buying it for IP rights and to not let their competitors get it. But at the same time, Netflix won because they got a $2 billion severance package from the deal, and Paramount is going to take a long time to even see profit from that.
Can you go to the comps page? Disney is trading at a much lower valuation than Netflix. It has great content. Why not recommend Disney instead of Netflix?
Well, yeah, Netflix is capital light, while Disney has to produce their own shows. Again, they do rely on some legacy. They are still producing new, solid shows that younger audience enjoys, but Disney is just a different business model. They also have a lower return on invested capital because they own all those studios. What we're focusing on Netflix in this is their ability to generate EBIT, operating income, and that they're capital efficient. They can move into any market that they want, and that they're internationally expanding.
I would like to add on to that Netflix sets itself apart by its Netflix originals, and we kind of talked about how they are able to distribute that internationally and data-driven insights and how that distributes. So I think that Disney doesn't do the original segment in that same manner.
They're also out-competing Disney in the original segments. As we saw in the chart earlier, they had 33 of the top 50 shows, meaning that they don't have to own the studios while out-competing legacies like Disney.
Also, for international expansion, I think they're a lot more capital light, and that allows them to put lower price points in those international markets and have a higher consumer retention rate there.
Why is like Amazon not a competitor from like a streaming perspective?
Yeah, it is absolutely a competitor. We're not able to find like deep,
Program.
proper financial
Yeah.
data for Amazon because of that.
Yep.
Are there any other international companies that are like Netflix in any way?
In the streaming services,
Yeah.
no. Netflix is by far the most internationally focused and spread out right now. There's not nearly, it's not even close to what the competitors are doing.
Is
Obviously,
there a Chinese version of Netflix?
there is Netflix in China. And I know there's also a Chinese streaming platform that is more popular than Netflix in China at the moment.
Yeah.
Yeah.
China also has regulatory issues. They don't allow very much Western media to go over there. YouTube cannot over there; it's banned. And when it comes to international companies, Disney is international, but really only in India, and not very much. So all the other streaming platforms are having a hard time expanding, like Netflix is.
So, how could this go wrong? What could make this not a good buy?
Yeah, if the main thesis as a part of our model were retention rate and ad revenue growth. And so if the retention rate starts to decrease, for example, if Netflix were to be too aggressive on price hikes, which we definitely don't see them doing, but if that retention rate starts to decrease and they lose their sticky customer base, that's a big risk. Second to that is ad tier growth not being as high as they project. That's going to be a big revenue driver for them in the US and in Canada, which is 56% of the revenues. And so we see those two things as if those assumptions aren't met, as being bad for Netflix.
What about live sports? Is that a risk opportunity? How do they compete against ESPN?
Yeah. So Netflix isn't weighted as high in live sports and live events as their competitors. These deals with sports companies like MLB and the NFL.
They are expanding into live sports. They have a partnership with the Japanese Baseball League.
Are we allowed to speak?
Oh,
Yeah.
my bad. I didn't hear it.
We're not listening anymore. So.
Thank you.
Thank you.
Yeah, thank you.
Okay.
Thank you.